Ladies and gentlemen, it finally happened. Silver just crossed $100 for the first time, and if you hold silver, you felt it in your stomach, because this isn't just another candle, this is a turning point. Years of being told you were wrong, years of the market calling you paranoid, and still, inevitable. And here's the detail that changes everything. The SHFE COMEX spread just hit about $13.50 per ounce, a record. It broke the old normal range of $8 to $12, and it wasn't an accident. Quick warning, this is educational and opinion-based content, not investment advice. Do your own research, and if needed, consult a professional. Today I'm going to show you what this gap really means. No fluff. And I'll end with a simple plan. What to do in the next 24 to 72 hours if you're a stacker, especially if you're 40, 50, 60 plus and you want protection, not adrenaline. Let me start by acknowledging what this moment means emotionally before we get into mechanics. For everyone who accumulated silver when it was $15, when it was $20, when friends and family said you were wasting money on shiny rocks, this is vindication. Not because $100 makes you rich, because $100 proves the thesis was correct. The system was fragile, the pricing was disconnected from reality, and physical metal was the right hedge against that fragility. But vindication is not the same as resolution. $100 is a milestone, not a destination. And the 1350 spread between Shanghai and COMEX is not a cause for celebration. It's a warning that the system is losing the ability to maintain coherent global pricing. When different regions of the world price the same commodity at levels that differ by more than 10%, you're not watching normal market function. You're watching market breakdown. Let me explain what the SHFE COMEX spread actually represents, so this makes sense. SHFE is the Shanghai Futures Exchange, where Chinese participants trade silver contracts for delivery in China. COMEX is the Chicago Mercantile Exchange, where Western participants trade silver contracts for delivery in approved U.S. locations. In a functioning global market, these two prices should stay very close together because arbitrage would close any significant gap. If silver is cheaper in New York than Shanghai, arbitrageurs should buy in New York, ship to Shanghai, and capture the difference. This arbitrage keeps regional prices aligned. A few dollars of difference is normal and reflects shipping costs, insurance, currency exchange, and time. But $13.50 is not normal. $13.50 is more than 10% of the base price. That's not a spread that reflects logistics and transport costs. That's a spread that reflects inability to move metal from where it's quoted cheap to where it's bid expensive. And here's the question that should terrify anyone watching these markets. If the metal exists and the spread is $13.50, why doesn't the gap close? Because closing a gap requires one thing: metal moving and delivery working. And when that jams, the difference becomes an abyss. When physical detaches from paper, the market doesn't correct. It breaks or it reprices, and we're watching that process unfold in real time. Let's simplify this like adults. If in one corner of the planet the price is one thing, and in another corner the price is another thing, that's not noise. That's structure losing integrity. And what most people don't understand is a spread isn't just a difference. A spread is pressure. It's the market saying, I no longer believe this price represents metal that's actually available. Shanghai is paying $106.50 or higher for physical silver because that's what it costs to secure metal for immediate delivery in China. COMEX is quoting $93 because that's where futures contracts trade among participants who mostly settle in cash rather than taking delivery. These are not the same market anymore. They're two different markets trading under the same name with increasingly disconnected prices. The significance of $100 goes beyond the number itself. 100 is a psychological barrier that changes market behavior. It's where the audience that was waiting for confirmation steps in. It's where the undecided become buyers, and where the market starts pricing in perceived scarcity. This creates a domino effect. More attention leads to more demand. More demand creates more pressure on inventory. Inventory pressure raises premiums, and paper markets try to pretend nothing happened. We've seen this pattern before on smaller scales. When gold crossed $1,000, when Bitcoin crossed $10,000, round numbers attract attention, and attention attracts capital. But silver crossing 100 is different because it's not happening in isolation. It's happening alongside a record spread that confirms the round number. Breakthrough is not speculative froth. It's structural repricing validated by physical market conditions. Now let's talk about the number that terrifies people once they understand it. Hundreds of paper promises for every ounce someone actually wants to take. I'm not saying every contract becomes delivery, I'm saying the obvious. When too many people try to exit through the same door, the system reveals what it really is. A price-setting mechanism, not a physical distribution mechanism. The exact ratio between paper claims and physical metal available for delivery is debated. Estimates range from 50 to 1 to over 300 to 1, depending on how you count ETF shares, unallocated accounts, and futures open interest. But the specific number is less important than the principle. The system sold more claims than it can honor with physical delivery. This works fine when most participants accept cash settlement. It fails catastrophically when participants demand metal. And demanding metal is exactly what's happening. The Shanghai Premium tells you that Chinese industrial consumers and investors are demanding physical delivery at prices well above Western paper quotes. They're not interested in COMEX contracts settled in dollars. They want metal in Shanghai vaults for immediate use in manufacturing or as strategic reserves. This shift from paper acceptance to physical demand is what's driving the spread to record levels. Here are the three gears that turn a spread into a historic event. First, arbitrage stalls. If it were easy, someone would buy cheap on one side, sell expensive on the other, and it's done. But real arbitrage has cost, time, logistics, rules, margin, foreign exchange risk, and most importantly, metal availability. The 1350 spread exists because arbitrage cannot function. Metal is not available in New York at prices that make shipping to Shanghai profitable after all costs, or metal is available but cannot be shipped due to export restrictions, refining bottlenecks, or logistics failures. Second, inventory shows up on paper and disappears in the real world. When investors start demanding physical, the question changes. It's not what's the price, it's is there metal. Exchange inventories might show 250 million ounces of registered silver at COMEX. But how much of that metal is actually available for delivery to new buyers versus encumbered by existing claims or held by parties unwilling to sell at current prices? The paper inventory and the available inventory are not the same thing. Third, premiums tell the truth before spot does. Retail usually screams first, spot usually denies first. Dealers selling physical coins and bars to retail customers see demand shifts immediately. When premiums for American Silver Eagles or Canadian Maple Leafs jump from $3 over spot to $8 over spot, that's the physical market repricing ahead of the futures market. The premium is the truth. The spot price is the lag. Now, I need to address the elephant in the room. Manipulation. Many in the silver community have described silver as suppressed for decades, as one of the most manipulated assets in history. Here's how to think about this productively without getting lost in conspiracy theories. Don't keep chanting manipulation like a mantra because people get fatigued with that narrative. What holds attention is mechanism plus proof plus consequence. The mechanism is straightforward. Large banks hold short positions in silver futures. These positions are disclosed in regulatory filings. When prices rise, shorts lose money. This creates incentive to prevent price rises through legitimate trading activity, selling futures, adjusting quotes, managing inventory. No conspiracy required, just self-interest and market position. The proof is in the data: concentration of short positions, timing of large futures sales during price rallies, regulatory fines for spoofing and manipulation already assessed against major banks. The consequence is what we're seeing now: decades of paper market dominance keeping prices below levels that physical fundamentals would justify. But suppression only works while physical supply is adequate. Once physical supply becomes genuinely scarce, paper selling cannot maintain artificially low prices indefinitely. The market eventually forces repricing. $100 crossing and $13.50 spread are evidence this repricing is underway. The control mechanism is failing. When a market breaks a record divergence, it usually points to one of three endings. Scenario A, convergence to the upside, paper chases physical, spot rises to shrink the abyss. This is the most economically logical outcome. If physical metal trades at 106.50 in Shanghai and 93 on COMEX, COMEX prices should rise toward Shanghai prices because that's where actual metal changes hands. The paper market would be admitting that physical scarcity is real and pricing must adjust. Scenario B, convergence to the downside through intervention. Rules change, margins change, buying gets cooled. It's the market trying to buy time. Exchanges could raise margin requirements dramatically, making leveraged long positions too expensive to maintain. Regulators could impose position limits, reducing the size of bets. Governments could release strategic stockpiles to increase supply temporarily. These interventions would create downward pressure on prices and potentially narrow the spread, but they would confirm rather than refute the shortage thesis. Scenario C, a new price regime, and this is where the game changes. It's not a rally, it's a structural repricing. The two markets remain separated permanently. Shanghai and other physical markets trade based on actual metal availability at whatever prices clear real supply and demand. COMEX and other paper markets continue trading based on financial flows among participants who rarely take delivery. The global silver price fragments into regional prices, with persistent differences that arbitrage cannot close. Each scenario has different implications for holders and buyers. Scenario A, upside convergence, means anyone holding physical or allocated silver sees significant appreciation as paper markets catch up. Scenario B, intervention and downside convergence, creates volatility and temporary pullbacks but doesn't change the underlying physical tightness. Those with patience and strong hands use pullbacks to accumulate more. Scenario C, permanent fragmentation, means you must be very careful about what kind of silver exposure you own. Physical metal or allocated storage in regions with tight supply maintains value. Paper instruments in regions attempting to maintain low prices may not provide the protection you expect. The trigger that determines which scenario unfolds is simple. Does the metal disappear or not? If metal circulates freely, if mine production increases, if above-ground inventories prove larger than estimated, the system adjusts and normalizes, spreads narrow, prices stabilize, market structure returns to historical patterns. But if metal jams, if circulation is impaired by export controls or logistics, if inventories are exhausted, if mine production cannot respond, the system must either pay significantly more or change the rules. We're testing which reality we're in. Let me give you the time map for how this is likely to unfold. Next 24 to 72 hours, late buyers rush in, dealers adjust premiums and availability. Everyone who was waiting for confirmation that $100 was real will attempt to buy. This surge in retail demand will stress dealer inventories and widen premiums further. Expect to see sold-out notifications, extended delivery times, and significant premium increases if you're attempting to buy physical. Next 2 weeks, the gap becomes the story. Institutions watch. Does it close or get worse? Any inventory or delivery headline becomes gasoline. If COMEX reports significant withdrawals, if Shanghai premium widens further, if major dealers announce supply constraints, these headlines will attract additional attention and buying. The market will be hypersensitive to any data point confirming or challenging the scarcity narrative. Next 90 days, if the gap persists, it becomes the new normal and the global price loses authority. After 3 months of sustained $13+ spreads, market participants will stop treating it as temporary anomaly. Industrial consumers will adjust procurement strategies assuming different regional prices are permanent. Investors will recognize that exposure location matters enormously. The illusion of a single global silver price will be dead. Now let me give you the practical guidance you actually need. If you have silver, you don't need to act fast. You need to act right. Here's the no panic checklist with 5 points. First, real inventory. How much you have, where it is, what's liquid first. If you hold physical metal in personal possession, allocated storage, or unallocated accounts, understand the differences. Physical in your possession is most secure, but least liquid for large amounts. Allocated storage provides security with better liquidity. Unallocated accounts are claims on metal that may or may not be available during stress. Second, security and storage. Don't increase risk because of euphoria. $100 silver makes your stack more valuable but also more attractive to theft. If security was adequate when silver was $30, it may not be adequate at $100. Consider whether storage location, insurance, and access protocols need adjustment. Don't broadcast your holdings on social media. Don't tell casual acquaintances you're a stacker. Operational security matters more at higher prices. Third, buying. Avoid emotional all-ins. Use steps. Dollar cost averaging remains the disciplined approach. If you plan to buy 20 ounces per month, continue that plan. Don't panic, buy 100 ounces this month because price crossed 100. The premium you'll pay during a rush is likely far higher than continuing steady accumulation. Likewise, don't stop buying completely assuming you've missed the move. If the thesis is correct, 100 is not the top. Fourth, exit plan. At what ranges do you take some off, even if small? This is personal and depends on your goals. Some stackers will never sell metal regardless of price because they view it as insurance against system failure. Others have specific price targets or financial goals. If you're in the latter group, define those targets now before emotional pressure of further price moves clouds judgment. Consider scaling out rather than all or nothing exits. Taking 20% of holdings off at 120, another 20% at 150, preserves optionality. Fifth, noise versus signal. Price is noise, spread plus premium plus inventory is signal. Daily price candles will whipsaw violently. You'll see 10% moves in both directions. These moves are noise generated by leverage, forced selling, and speculation. The signals that matter are Is the Shanghai COMEX spread widening or narrowing? Are physical premiums rising or falling? Are dealer inventories depleting or rebuilding? Are delivery times extending or normalizing? These indicators tell you about actual physical market conditions rather than paper market sentiment. Let me be direct about price targets because people always ask. I'm not going to sell you a magic target, but I'll give you an adult way to think. If the market accepted 100, it now tests above and below to find the new base. Psychology suggests 100 becomes support rather than resistance once it's clearly broken. Pullbacks to $95 or even $90 are possible and healthy, but sustained trading below 100 becomes increasingly unlikely unless something fundamental changes in supply or demand. If the spread stays high, the psychological floor rises with it. If Shanghai continues paying 106 while COMEX quotes 93, the floor is realistically 106 minus arbitrage costs. That puts the true floor somewhere around 98 to 102 depending on logistics. Below that level, arbitrage should activate buying pressure assuming metal can actually be moved. If there's intervention through margins or rule changes, you can get a pullback, and that doesn't mean it's over. It means there's a fight. The paper market attempting to reassert control through administrative measures. The physical market resisting because metal is genuinely scarce. These fights play out through volatility that shakes weak hands. Those who understand the mechanism hold through the volatility or even add during manufactured sell-offs. Here's what the establishment wants you to believe. $100 is the top. The retail rush will exhaust itself. Industrial demand will fall as manufacturers substitute alternatives. Mine production will surge responding to high prices. The spread will close through normal arbitrage. Order will return and silver will settle back into $80 to $90 range. This narrative is comforting and may even contain elements of truth, but it misses the structural changes that make this cycle different. Here's what the data suggests instead. $100 is a waypoint, not a destination. Industrial demand is inelastic because substitution options are exhausted. Mine production cannot surge due to geological and capital constraints. The spread will close through COMEX repricing higher, not through Shanghai falling, and the order that returns will be different from the order that existed before. Higher base prices, persistent regional differences, physical markets dominating price discovery rather than paper markets. If you held silver all the way to here, you're not watching a video. You're watching a chapter of confirmation. $100 was the door. The 1350 gap was the warning. And now the market has to choose. Either it delivers metal or it delivers price. Those are the only two options when physical detaches from paper at scale. The system cannot deliver both low prices and adequate physical supply. It must choose. The establishment's first choice will always be attempting to deliver low prices through paper market manipulation, raising margins, selling large futures positions, creating volatility that shakes retail confidence, controlling narrative through media that describes the move as speculative bubble. These tactics worked for decades. They may continue working for weeks or months, but they cannot work indefinitely against genuine physical scarcity. Third, buying, avoid emotional all-in. Eventually, the system will be forced to deliver price instead of metal. COMEX quotes will rise to meet Shanghai. Premiums will remain elevated or increase. Delivery delays will extend, and participants will learn the hard way, the difference between owning paper claims and owning physical metal. Those who positioned correctly beforehand will benefit enormously. Those who trusted paper instruments will face disappointing outcomes. Remember that silver touched $50 in 2011 and then declined to $14. That's 72% drawdown over 4 years. Anyone who bought the top in 2011 and sold the bottom in 2015 experienced catastrophic loss. But anyone who bought the top in 2011 and held through to today at $100 more than doubled their money. The lesson is not about timing perfection. The lesson is about position sizing that allows you to hold through inevitable volatility. The 1350 spread provides additional confidence that $100 is not speculative top, but fundamental repricing. When silver touched $50 in 2011, there was no comparable spread between regional markets. Prices were globally aligned. The rally was driven primarily by investment demand and speculation. When it reversed, physical markets weakened along with paper. The current situation is different. Shanghai paying $13.50 over COMEX confirms that physical demand is real, that scarcity is genuine, that repricing has fundamental basis. Now let me tell you what happens if you do nothing. If you're already a stacker, doing nothing means continuing to hold. This is probably the right choice for most people. You accumulated metal for protection, not speculation. $100 validates your thesis, but doesn't change your need for protection. Unless you have specific financial needs requiring liquidation, holding through this transition makes sense. You're already positioned correctly. If you're not a stacker and you do nothing, you're making an active choice to remain exposed to fiat currency risk and financial system fragility without physical metal hedge. This choice may prove correct if the establishment successfully suppresses prices again, if mine production surges, if industrial demand collapses. But each of those outcomes seems less probable now than before $100 breach and $13.50 spread. Doing nothing is not neutral. It's a bet on system stability and paper market control. For those between these extremes who hold some silver but feel allocation is insufficient, the question is whether to add at these levels. My framework is simple. If you believe the thesis, if you understand the mechanisms, if you're sized appropriately to withstand volatility, adding through dollar cost averaging makes sense. Not panic buying your full desired allocation this week. Systematic accumulation over next 6 to 12 months that averages entry prices across whatever volatility emerges. The biggest mistake you can make is getting the thesis right but the sizing wrong. Being correct about silver but allocated too heavily and forced to sell during a manufactured sell-off. Or being correct about silver but allocated too lightly and missing the move because you waited for perfect entry that never came. Both mistakes are avoided through systematic, disciplined accumulation at levels you can hold, regardless of short-term price action. Let me end with perspective. Silver crossed $100. This is an extraordinary event that most analysts said would never happen or would take decades. It happened faster than almost anyone predicted. The $13.50 spread confirms this is not speculative bubble, but structural change. The physical market and paper market have diverged to historically unprecedented levels. The system that maintained artificially low silver prices for decades is losing control. But extraordinary as these developments are, they're not the end of the story, they're the middle. The establishment will fight to regain control. Volatility will increase, not decrease. Narrative battles will intensify as mainstream media alternates between ignoring silver's moves and dismissing them as unsustainable. Your advantage is understanding the mechanism underneath the noise. Spread tells you about physical tightness. Premiums tell you about real-world availability. Inventory tells you about supply constraints. Price candles tell you about paper market sentiment, which is often wrong. If you held silver to 100, you demonstrated patience and conviction that most people lack. If you accumulated during the years silver traded between $15 and $30, you positioned brilliantly. If you bought recently above $80, you still positioned reasonably, assuming you sized correctly. The question now is not whether to celebrate being right. The question is whether you're positioned correctly for what comes next. And what comes next is either violent repricing higher as paper meets physical, or intervention and volatility as the system fights to maintain control before eventually repricing anyway. Either path leads higher over time. The route may differ, the speed may vary, pullbacks will occur, but the destination is determined by physical fundamentals that cannot be wished away through paper market manipulation. $100 is not the top. It's the door opening to the next phase. The $13.50 spread is the sign above the door reading "They lost control." Whether you walk through that door is your choice, but don't pretend the door isn't open. Don't pretend the sign isn't there. And don't pretend that what comes next will look like what came before. The market just told you everything changed. Listen to what it's saying. If you enjoyed the content, please like the video and subscribe to the channel so you don't miss future updates. Thank you for watching, and see you next time.